Hi, I'm Conor O'Brien, CEO of O-Shares Investments, and with me today, Kevin O'Leary. How are you, Kevin?
Great, thank you.
So we're going to talk about is large cap and really just debate the issues of investing in value, growth, or quality, and fitting the theme of repositioning for slower growth, whether it's slower economic growth, slower earnings growth. Everybody has their own theory. Let's take a look at a slide here before I turn it over to Kevin. This basically shows the repricing of large cap equities, and what you see is the current valuation is well below the 5-year average, something in the 17 times area. So Kevin, tell us your thoughts on the market pullback and your views on investing in large caps.
So the large cap S&P 500 companies are usually the core of any equity portfolio, and there's no different from mine, except I don't want to own a straight index of every S&P company because given the pandemic we've been through, given the change in the economic environment around interest rates, because the Fed is raising rates to fight inflation, there are many companies in the S&P that are going to do much worse in terms of market capitalization than others. I want companies that have less debt, generate more returns from a measure of return on assets, and generate cash that they provide distributions with in the form of dividends. Because the combination of long-term investing, if you look at it, is dividend payers give you more stability, and they certainly provide returns in addition to just capital appreciation. And so that's what I'm looking for. And within the S&P 500, there's around 100 companies that are, let's say, stars or winners or better off in terms of their balance sheets. For example, I don't want to own airlines. They're upside down after the pandemic. They packed on so much debt. That's not a good place to be. And there's other sectors like that too. But you can index for strength of balance sheet. You can index for a high return on assets. You can index for distributions that are stable and not created with debt. So that's what you're looking for, and that's what I do. I use a subset of the S&P for the core holding of my portfolio, and I find that's the best way to do it in terms of price stability and capital appreciation and distributions.
Your comments sound a little bit like Warren Buffett. You like dividends and high quality companies, and certainly worked out for Warren Buffett over his decades. Let's take a quick look at a couple of things that in these slides, next slides. So you commented on value, growth, blend. What are your thoughts there? Is value a trade? Is growth too soon? Is a blend too much risk? And does that steer you towards quality dividends?
Well, value is a difficult term, and I say that because I've been investing for decades. People are always showing me stocks that have had massive corrections, like a Kmart, and calling it value. Well, the problem is value is just an elevator stop on the way into hell, because that's the problem. You're trying to catch a falling knife sometimes in value. There's no value in a company whose business model is broken. Just because the stock price has depreciated doesn't mean that it's value. And often you find these situations where dividend yields are 6, 7, 8%, but they're not sustainable. The company's broken. So I much prefer to measure the value of a stock based on its ability to maintain its business model, not pack on debt, provide distributions, and grow somewhat. And that's what I'm focused on.
That's great. I'm going to just show people a quick slide here on the scatter plot. Let's skip to that one. This basically shows you the OUSAX index historic backtest performance versus value. And what it really shows is you win when it matters most. If you're an investor who wants to avoid a lot of downside and stress events, it's a 3-year batting average. And it basically shows 100% success when markets are weak in outperforming value. And so the next slide just shows people how, in a different way of stress event, looking at the worst period for every single calendar year has some period, short or long, that is a down period, and it's either down a little bit or down a lot. What you see here is the OUSAX index avoids a lot of the downside quite consistently across the years, about 30% less downside than the generic value index. So Kevin, just a word from you. What is your allocation going into 2023, your allocation to the OUSAX strategy?
It's 40% of my portfolio. It's the core. It's the largest. It's, for me, a way to provide some stability, at the same time try and hit my target of a 6% distribution annually. That's how I do it. And I think the value for me in that is it's constantly being reconstituted based on the quality metrics that it uses within the S&P. So I really focus on getting the returns from the capital appreciation, but at the same time, I really want to know that these companies have stable business models that are profitable and they don't use debt to increase their dividends.
Fantastic. Well, thank you very much, Kevin, and thank you everybody for watching the video. Please just send us a note, info@oshares.com, or go to the website, of course, at oshares.com. Thank you, everybody, and have a great day.